In December 2024, the trade desk hit an all-time high of $141 a share and Wall Street could not get enough of it. Analysts were raising their price targets, the company was growing revenue at 26% a year and its margins were among the best in all of tech. Then the stock fell 83%, and today it trades around $24. But here's the part that makes this setup genuinely interesting. While the stock was collapsing, the business was doing the opposite. Revenue hit an all-time record high, profits expanded, and the CEO walked into the open market and bought $148 million worth of shares with his own money. Let me show you what this disconnect actually looks like in the numbers, because it is striking. The trade desk generated $2.9 billion in revenue last year, which is an 18% increase over the prior year and an all-time record for the company. Gross margins sit at 79%, EBIT margins are above 20%, and net income came in at $443 million. These are elite numbers by any standard in software. Meanwhile, customer retention has stayed above 95% for 12 consecutive years, which means virtually nobody who starts using this platform ever leaves. These are fantastic numbers. And yet the stock is down 83% from its highs. The business is compounding, the financials are pristine, and the market is pricing it like something is seriously broken. Before we dive into the full thesis, you need to understand what this company actually does, because the trade desk is not a household name, but it is one of the most important companies in digital advertising. Every time you see an ad on a streaming service, hear one on a podcast, or encounter one on a website or digital billboard, there is a good chance it was purchased through something called a demand-side platform, which is basically the technology layer that lets brands and agencies buy ad space across the internet in real time. The Trade Desk is the largest independent demand-side platform in the world, and the key word there is independent. Google and Meta are walled gardens that sell ads exclusively on their own platforms, but the Trade Desk is the neutral layer that lets advertisers buy everywhere else, across connected TV, audio, mobile, display, and digital out of home, all through a single system. In 2025, $13.4 billion in gross ad spend flowed through this platform, and the company kept $2.9 billion as revenue. The business model is pure software with no inventory to own and no content to produce. Here is bull case number 1, and it is the foundation of the entire investment thesis. Television advertising is a $170 billion global market that is going through the most dramatic structural shift in its history. Cable is dying, streaming has taken over, and every major platform has now launched an ad-supported tier. Netflix, Disney+, Amazon Prime Video, Peacock, all of them. And every single one of these platforms needs a way to sell ads programmatically at scale, which is exactly what the Trade Desk was built to do. US connected TV ad spend hit $33 billion last year and is projected to reach $38 billion in 2026, then cross $52 billion by 2029. The critical detail is that over 84% of CTV advertising is already being bought programmatically through platforms like the Trade Desk, and that percentage is climbing. Connected TV already accounts for more than half of the Trade Desk revenue, but the market itself is still in the early innings. Streaming only surpassed cable in total viewing time last year, and the advertising dollars have not caught up to where the audience already is. When they do, the Trade Desk collects on every transaction. Bull case number 2 is the structural argument for why this company has a real moat. Google and Meta dominate digital advertising, but they operate as closed ecosystems where they control the data, the targeting, and the measurement. Advertisers have to take their word for it, whereas the Trade Desk represents the opposite model by giving advertisers full transparency and cross-platform reach across everything outside those walls. What makes this position defensible is something called UID2, an open source identity framework that the Trade Desk built to let advertisers target and measure users across the open internet without relying on third-party cookies. It now has more than 500,000 publisher integrations and is becoming the default identity layer for the open web. Every time Google threatens to deprecate cookies, which it has been doing for years, the Trade Desk's alternative becomes more valuable. This is not just ad tech, it is infrastructure and infrastructure compounds. Bull case number 3 is the one nobody is pricing into this stock right now. In March 2026, reports surfaced that OpenAI held early discussions with the Trade Desk about bringing programmatic advertising into ChatGPT. The implications of this are enormous. ChatGPT has 910 million weekly active users, and OpenAI estimates that advertising could contribute $17 billion in consumer revenue this year alone. With early ad pricing set at a $60 CPM, the data already show that users arriving through LLM conversations convert at 1.5 times the rate of traditional channels. This is huge for the trade desk. OpenAI does not have an ad tech stack, agency relationships, or measurement infrastructure, so building all of that from scratch would take years. The trade desk already has the entire system in place, which is why it is being brought into the conversation. Now, I want to be clear that this is early stage and no deal has been formally confirmed, but the signal matters. AI is creating an entirely new category of advertising inventory, and the trade desk is positioning itself to be the demand-side platform for it. Now let me show you something that almost never happens in public markets. In early March 2026, CEO Jeff Green went to the open market and purchased 6 million shares of the trade desk with his own money, spending $148 million at roughly $24.68 a share and increasing his personal stake in the company by 373%. I have covered a lot of stocks on this channel, and I have never seen an insider buy this large from a sitting CEO. This is not a $500,000 confidence signal or a token purchase for optics. This is a founder who has been building this company for 17 years, putting $148 million on the line because he believes the market has it completely wrong. Insiders sell stock for all kinds of reasons, but they only buy for one. Jeff Green co-founded the Trade Desk in 2009 after building AdECN, an early ad exchange that Microsoft acquired in 2007, and he has been running the Trade Desk ever since. He is a founder CEO with 17 years at the helm, significant personal ownership, and now a $148 million open market purchase that signals he believes in the next chapter of this business more than at any prior point. Beyond the CEO's personal conviction, the company itself spent $1.4 billion buying back shares throughout 2025 at an average price of $52.60, which is more than double where the stock trades today. That tells you exactly where management thinks fair value sits. The one area to monitor is the CFO position, because Laura Schenkine departed in August 2025 and was replaced by Alex Kayal, who came from Salesforce Ventures and had been on the board since early 2025. The transition was planned, but it is the second CFO change in 3 years, and that warrants your attention. Let me walk through the financial picture quarter by quarter so you can see the trajectory for yourself. Q4 2025 revenue came in at $847 million, beating analyst estimates and marking the strongest quarter in company history. For the full year, every single quarter showed sequential growth, with revenue stepping up from $616 million in Q1 to that $847 million in Q4. Free cash flow in Q4 alone was $282 million, which demonstrates that this is not a company burning cash to grow. It is throwing off real money while still investing heavily in its own platform. At today's price, the stock trades at roughly 27 times earnings and 3.8 times sales. For a company with 79% gross margins and a 12-year track record of holding onto its customers, those are valuations you typically only see when the market has decided the growth story is over. Now, let me be honest with you, because this channel does not do blind optimism and every thesis has holes. The biggest risk is growth deceleration. Revenue growth dropped from 26% in 2024 to 18% for the full year in 2025, with Q4 slowing to 14% and guidance for Q1 2026 implying roughly 10%. That is a clear downtrend, and if it continues, the current valuation might actually be fair rather than cheap. The second risk is structural. Google, Meta, and Amazon still dominate digital ad spend, and if they tighten their ecosystems or make the open internet less viable for advertisers, the trade desk's addressable market gets smaller over time. Third, the OpenAI opportunity could be a double-edged sword, because OpenAI has publicly stated it wants to build its own ad tech capabilities long-term, which means any partnership with the trade desk might be a temporary bridge rather than a lasting revenue stream. And finally, executive turnover is worth watching. 2 CFO changes in 3 years during the worst stretch of the stock's performance raises fair questions about organizational stability. These risks are real, and they are the reason the stock is currently at $24 instead of $100 or more. Here's where I land. The Trade Desk is an elite business trading at a broken price. It has record revenue, best-in-class margins, the strongest customer retention in ad tech, and two of the largest secular tailwinds in advertising, connected TV, and AI, both running directly through its platform. The growth is slowing, and I'm not going to pretend that does not matter. It does. But the market is pricing this stock as if the business model is impaired, and everything in the financials says the opposite. The CEO betting $148 million of his own cash, and the company buying back shares at more than double today's price tells you exactly what the people closest to this business believe. At this valuation, with this balance sheet and this level of insider conviction, I think the potential upside far outweighs the downside over an 18 to 36 month horizon. That is my case for the Trade Desk. If you enjoyed this breakdown, hit the like button, and if you want more breakdowns like this, hit subscribe. Every video on this channel is a case built on real data and zero filler. I will see you on the next one.